Hey everyone, hopefully you're having a good day. My name's Andy. My channel is Finding Value. Today we're going to go over one post on Twitter and I'm going to answer it in a very long-winded, lots of information given in this answer here. It does relate to the thesis of the channel, or not really the thesis, it's more or less just the business cycle to some extent. And someone posted this. I'll show it to you right now and I'll give you my opinions around it. But this is what they posted. It says on Twitter, U.S. inflation today versus 1974 to 1984. And what they're basically doing is they're overlaying the fractal of today versus previous fractals in history. And maybe it plays out this way. Maybe it doesn't. But I can give you my opinions and all the data so that you guys can make your own decisions. So the question is, why is this CPI pattern forming the same way as the 1970s? Are we going to go into a recession? It says in the 1970s, it took 2 years for inflation to normalize, and then it came back. What drove this? Why does it look like that? I'm an engineer by trade. I get problems all the time. And you go back to what is given and what you have as information. So this is information that's the given. We know that this pattern is the same or is scribing out to be very similar compared to history. What's causing the pattern? What's driving this pattern? What drives inflation? What causes inflation? What are the drivers of the making of this chart? That is what everybody should be asking themselves. It's not what are we looking at to validate where we are in a cycle. What is driving these cycles? And in my opinion, if I were to look at drivers of the cycle, I think it comes from demographics. Now, I put together this presentation here real quick, and I wanted to show you guys what I know. And in my opinion, what prices assets is the demographics of the United States interacting with our housing market. Now, I know some of you guys have seen this before, and I know it might be new, but I'm just going to go through it all real quick. When you look at the birth rates, this is the annual percent change in the U.S. population from 1900 to 2021. The bull markets that we had are all these upswings in the demographic. Every single one resulted in a commodity bull market as long as commodities were cheap in relationship to stocks, and we got a credit expansion in the system. So basically, what those conditions are telling us is that you had a demographic coming into home buying years, increasing the credit expansion in the system, and also increasing spending in the system to fill those homes with whatever they need, more diapers because they're having kids, more sofas, more TVs, more whatever it is that they need to fill that home up with. So these upswings, these percent changes in the demographic or population change are what caused the credit expansion, leading to commodity bull markets and a repricing of assets with an increasing interest rate environment. Some of these cycles are bigger than others, and some of them are smaller than others. We can see that looking at other data, specifically the size of the interest rate moves. So if you were to look and look at this, and you have to keep in mind, we're not just looking at the population growth, we're looking at the population growth at home buying years. So you have to add 20 to 30 years to this number, depending on where you're at. And you may need to add 35 to 40 years, because what is determining this is the people of age that are first-time home buyers. So the average age back here might have been 20-something years old. The average age over here might have been 30 years old, and the average age over here might be 35 to 40 years old, depending on the first-time home buyer's average age. And right now, I think it's between 36 and 40 years old. So if I were looking at this, what I would project is we would see a gigantic housing market boom in the 1940s here, if you add 20-something years. You had 30 years to 1940. That puts you at 1970 all the way to 1982 or 3 or 4 or something. Then we went into a disinflationary period all the way down to 2020 if you add 30 years. And then you'd have a move from 2020 all the way, if you add 35 years to maybe mid 90s, you'd get something like 2030. This is where I think the driver of that credit expansion is. And if you look at the demographic, this is the US population by age, millennials making up the largest population cohorts in the US and are of coming of age. This here that I just showed you is a percent. This is an annual percent change. It doesn't tell you anything about the volume necessarily. As you go from left to right, the volume of people increases as you go to the right. So this move from 0.5 to 2% in total might be smaller than this move, given the percent change over the size of that population at that time. So you have to know the size of population. What this does is basically tells us the size of the population at a certain age. And as you can see, people are passing away as you get above 60 years old for the most part. But if you look, what we want to see is we want to see a low point moving upward like that. What this is telling us is that we are basically strengthening into a home buying population with very good volume. So we're coming from, let's say, 45 years old. If the average first-time homebuyer's age is somewhere between the age of about 30, I'll just say 35 and 40 years old, I think is the current data. This is where the first-time homebuyers are, and you can see the move up. And we continue to move up all the way till about 27 or 8-year-olds. So if we're kind of in this, that means we've got 1, 2, 3, 4, 5, 6, 7, 8, 9, maybe 9 years left, maybe 8 years left. It's not going to be perfect, but maybe we've got 6, 7, 8 years left with a increasing demographic coming into home buying years, which means there's a pressure of these millennials coming into home buying age to buy more homes. And there's more of those people. Now, tying in the housing starts and what they look like from 1890 to 2015. And I will get back to that fractal. Keep that in mind. Remember what I said. If this was 1920-ish, we would see a home buying spree in about 1940s. We would see another one in the starting here about 1960 something all the way up to 1980. So let's see what we got here. Well, here's the 1940s. There's your home buying spree, and notice there is a large difference in the 1940s than there was before. We went to an entirely different level in the housing starts, which means it's going to be a very inflationary period. That's what was driving the inflation, in my opinion. Was this, well, it's the first move here. We had a pullback, and then we had another large move. We also had a very large move in 1970 all the way till about the 1980s. So we had that double hump. So there's your one hump, your two hump, and then your third hump. Your humps are coming from the demographic and also the housing starts. So it's the way that the demographic interacts with the housing starts. So if we were to go back real quick, just to remind you what we're looking at, is this US inflation today in 1974, 1980, we had this first hump, second hump, and third hump. In the 1960s, it fell down to 1972. We came back up. So it's the interaction of the demographic with the housing market. So keep that in mind. What this is this is the credit expansion that we're seeing in the system for that time frame. And notice in the mid-1920s, we had a massive crash, which resulted in a deflationary crash in the 1930s. The depression was driven by the destruction of credit in the system, and it came from the housing market and foreclosures. The same thing happened in the late 2000s, and the gigantic foreclosures and delinquencies and all that credit destruction and the gigantic pullback in the housing starts. This is all tied together. So what I want you guys to look for here is there's three main drivers. There's the demographic There's the demographic, that's the population, basically, the population growth, interacting with the housing market. That's a credit expansion phase. Then on the consumer, so let's move back. The consumer price index is measured by the prices in the system. This here is where the credit is. This is the money expanding in the system. Money expanding in the system puts everything into a shortage, which is inflationary. Because more money chasing fewer goods means you have a shortage of goods in relationship to money. The other portion that can basically have an impact on consumer prices is the supply of commodities, because all products are basically a conversion of commodities into products. And that requires commodities and energy. So if you have a shortage of energy or a shortage of commodities, you will also see consumer price index inflation. So you could have both that happen at the same time. You could have a gigantic shortage of the supply and a gigantic credit expansion. And that's where you'll have the most explosive commodity bull market in the history of humankind, is when you have those two things align in the same thing. So going back to housing starts, this is the housing starts per 1,000 households, and we're focusing on credit expansion on this portion of it. So back in the 1970s, you can see how we went up in housing starts per 1,000 households. So we had a pretty large, we'll call it a housing starts adjusted for household ratio. But what happened down here in the 2010s? We underbuilt massively. That underbuild per 1,000 households ended up with a gigantic deficit. The way that you get a deficit is because in a gigantic housing supply boom with, we'll say, credit that should have never been lent out, the misuse of credit. When you combine those two things of an overbuild situation and the misuse of credit and the destruction of that credit, we went into a scenario where we underbuilt for a very long period of time. That's this entire section over on the right-hand side. We're going to have to come back up and build more homes to catch up the housing market, to get a better housing starts to household relationship. Because right now we are on the low side. The deficit that is projected by some people varies dramatically depending on where you look. It can range from anywhere from 3 million home deficit that needs to be built all the way to, there's even been people saying we have a 20 million home deficit. I don't know what the actual numbers are. All I know is that everyone's projecting a deficit to some extent. So what this is, the demographic interaction with the housing market throws us into what we call an economic cycle. We have a recession, that's the down phase here when we go below. So this is a recession here. This is a recovery phase. This is a expansion phase. And then this is a hyper supply phase where things got to slow down and we overbuild. And this thing repeats over and over and over and over. We can see this cycle through the housing starts if you want to see it. This here and where you are in this economic cycle, with economic growth slowing, accelerating, and the inflation curve, prices assets differently. So this one would be great in a recession. Bonds do very well. In a recovery phase, stocks or growth stocks do very well. And we'll go over this again in with another clip. High growth, high inflation, that's going to be natural resource stocks and commodities and precious metals. And then on the slowdown, it's still those three that I mentioned until we go into a recession. So this cycle repeats over and over, and it prices assets differently depending on where you are in the cycle. So here is the U.S. new single-family months remaining inventory. So this is inventory. Now, one thing I want you to kind of look for is that cycle. The cycle that we talked about in the beginning. The cycle of that recession always is, I'll say before that recession, you always have a gigantic increase in inventory of U.S. new single-family homes. And this is months of inventory. So we had an increase of inventory we pulled on back in 1970s. And there's your waves. First wave, second wave, third wave of inflation. So those waves are tied to this remaining months of inventory and housing starts. So if I were to go back to that picture again and they were to say, why do we have these waves? Wave 1, wave 2, wave 3. So the first wave here, and remember, inflation lags the housing market. So it's a little bit behind it. So 1967, and it kind of came back down in 71, 72. That was the inflation rate. So if we were to look at this, in the 1960s, we had an increasing number of months, and then we slowed down in the early 70s. 72 is where it bottomed, exactly like the inflation. Then we came back up for a second wave, then we came back up for the third wave. That is what's driving that inflation, is your inventory and your housing starts. And your housing starts are this. This is your housing starts. You have a cycle up. So your cycle up in 1960s came back, and then you come back up, come back, and then we came back up. That's the 3 waves that we're looking at right there in your housing starts. And the way that you can tell if something's being overbuilt is you look at your inventory. That is what's telling you when you're in an overbuilt scenario, and then when you're going to have some sort of crash. Now, here's the problem that we've got today. Today, our inventory is down here. We are below basically across everything. And I don't believe, so here's another thing that you have to understand with these cycles. This cycle here, interest rates can't fix this. You can lower interest rates, and as you come down, if the demographic ceases to exist, the supply will stay there. It won't really get fixed very quickly. It'll have to slowly draw down. And really, the way that you draw that down is you underbuild in housing starts. So people shift their focus to buying foreclosed homes, and they don't buy new homes as much. And that's why the housing starts decline and the credit pulls on back. What I think is happening now is the interest rates are at a level where the affordability is impacting the buyers. It doesn't mean that you'll get a crash because we don't have the inventory. And that's why I think that the interest rates are having an impact, is because you don't have the inventory going up like these years here. Could we have the inventory go up? It's possible. We just have to wait and see how the inventory reacts and how the demographic is interacting with the housing market. Now, this is what the valuation is, and this is time: stealth phase, awareness phase, mania phase, and blow-off phase. This is your cycle. This cycle is tied to this cycle. So if you were to look at a stock in phase 2, and we are going into phase 3 and 4, what that means is the stock in phase 2 is this, and then when we go into phase 3 and 4, it pulls back. If we're at the beginning of a phase, you're putting in a bottoming pattern, a W bottom pattern, an inverted head and shoulders, something on the lines of that. So when we look at this phase, we've got commodities at a different portion of this phase than the general stock market and the bond market. But we can look at those charts and we can gain information on where we are in this cycle based off of where the charts are telling us we're at. So when we look at this, what's important to know is that commodities might be here at the same time stocks are up here. But that's basically telling us where we are in this cycle. We're in the phase 3 overheat phase that we have to go into, because that is where the stock market is telling us that we're at, and where the commodity stock market is telling us where we're at. They are telling us where these locations are at. Now, when I look at the commodity price index versus the Dow Jones Industrial Average, these cycles can also be very long in length. And what we've seen in history are these small cycles that come in, but it's creating a pattern, which is a consolidation pattern. And what's important here when looking at this from this big long-term view, this is, again, a ratio, commodity prices versus the Dow Jones, but this is from 1930 all the way onward. It's got the 3-hump pattern, and it's a declining type wedge. What happens if we break out of this and we move to the upside? What that is signaling is that commodities could have the largest up move of anything that anyone's ever seen in history. It would be the largest commodity bull market of all time. Now the question is, how does that happen? Why is that the time now? And I don't know the exact reasoning, but I can come up with some ideas. One of the reasonings could be that we are coming towards the end of a credit cycle and that the inflation will overwhelm the commodity or GDP expansion. It could also mean that we have massive supply shortages ahead of us in commodities where no matter how the system is designed to infinitely grow, but if you can't grow your GDP alongside that infinite growth of credit expansion, you're going to get a mismatch between your credit and your products or GDP. This would also signal a breakout to the upside and a big move to the upside, where commodities would vastly outperform the Dow Jones. The Dow Jones stocks are more or less just companies that convert commodities into usable products using energy. Commodities are your feedstock. That's your value. That is where all of the wealth is created and generated. It's the commodities. It's the energy and the metals and materials that go into making products. So this is one chart to say, look, there could be something massive coming to the upside. So we want to gather more evidence. Again, we want to know what the given is to make a decision of where we're at in this inflation cycle and where we're at with all of this stuff. So that is one. Here's another one. This is a long-term chart of platinum versus gold, and I know it's written in German. We've got the three phase, so it's one hump, two hump, three hump in the consolidation in a falling wedge pattern all the way from 1900 to the mid-2020s is up here. So it's over here. It's in the corner. What this is telling us is that we have a gigantic move of what could potentially be an inflationary period. Remember those periods. This here was Weimar's hyperinflation. This here was another large inflationary period from 1940s. Remember the housing starts and the credit expansion all the way till just before 1980. Then we have another one in the 90s to 2000s, which was a mini bull market. And I'll show you why it's a mini bull market. And what could be coming if we break out of this could be another gigantic move where platinum vastly outperforms gold. And again, this was back in the hyperinflation. And I know a lot of people said, well, gold outperforms silver in that hyperinflation. Well, according to this, platinum outperformed gold in that hyperinflation as well. That's pretty crazy. Now, looking at inflationary periods, just to kind of show you guys, energy stocks is another spot that does very well in terms of performance. So now we're looking at not just the data that's backing where we are potentially in the markets, it's how do you play it too. So energy stocks and some of these other ones, these charts are more data saying like something major is coming. And energy also is a good way to play it. Another way to play it is if it's a high growth, high inflation, or low growth, high inflation, what does well during those timeframes? Natural resource equities, gold, and commodities do very well. But they also do well in a low growth inflation environment. What these are, high growth and low growth, is where we are in the cycle. The cycle here is high growth, accelerating economic growth, high growth and high inflation, which inflation's picking up. On the backside, you've got a decreasing interest rate and decreasing economic growth. But this here is measured by, and what drives this is that demographic and the housing starts. We don't have a slowing down demographic, and we don't have inventory of homes. So I don't think that we're entering phase 4 yet because of those conditions in the market. So I think we're still in the growth inflation phase, perhaps, and we may peter out a little bit and then go back into growth and inflation. But it's highly dependent on where the interest rate is and the affordability of the housing market. So right now, I think they've got it at a level where they're basically trying to dial forward or backwards the housing market and inflation based off of the interest rate. So I do think that they have a balanced market. When you look at this and looking at another way to play this, and I know I've got this in here, other ways to play it under inflationary times is real assets, commodities, platinum. Platinum outperforms other precious metals. So a way that you could do it is if we did a platinum to gold ratio, we should see platinum go up during an inflationary period based off of this because platinum outperforms gold. And platinum also outperforms silver under inflationary environments. So we can also look at the ratio of platinum to gold and platinum to silver and say platinum, if it's outperforming it, and platinum to palladium, we should see that we're in an inflationary environment. Or conversely, if you think an inflationary environment's coming, platinum should be putting in bottoming patterns against those other metals and assets. This is the all-time lows, real assets relative to financial assets. This is a ratio chart. And you can see back in the 30s or back in the 40s, I should say, we saw real assets outperform financial assets in the 40s. Then the inflation subsided. We saw it in the 60s and 70s. So 65 was the bottom. That was that 3 wave. And then now we're at a very low level, and we started to come back up where real assets are going to outperform financial assets in 2020. And it's been outperforming the past few years. Here's more data saying that major inflation peaks, the blue dots, so that's the red dots. The blue dots are major inflation troughs. We came to a major inflation trough in 2020. And we should see a gigantic move in commodities to the upside because this is a commodities chart. And we could maybe peak out sometime in the next 10, 20, 30 years, whatever it is. And then looking at this, we've also got previous commodity supercycles peaked in the late 1970s and 2008. The 70s was a big commodity bull market. The 2000s was a mini boom. I'll show you why that is. And now we come up and we're starting to come up and break to the upside. Now, this is old data. I did this in the 2020, I think. This was the buy point that I was buying at the bottom here. And you can see the 3 consolidation, 1 hump, 2 hump, 3 hump. You can also see 1 hump. I don't know if this has got the 3. It's got 1 hump here, 2 hump here, 3 humps there. A lead-in pattern. So this is wave 1, wave 3, wave 5. And then into the consolidation period. We're still scribing out wave 1 with a pullback in wave 2. I'm not going to go over that. And I'll go into some more information here. So I'm going to bring that back and put this up here. And I'm going to go to the interest rates. So remember the 1940s and the 60s and 70s and whatnot. That was during a rising interest rate environment. That was a big boy commodity bull market. What also caused the bull market to be larger is we had a 1970s peak oil in that time frame, which created a shortage in energy. And that shortage of energy was a driver of inflation. So it was credit expansion in the housing market and the demographic coming into home buying years, and a supply problem with energy, oil in specifically because of peak oil in the United States alone. But that was only subject to America. We are now, I think, entering a worldwide oil supply problem. If that's the case, and we see a new shift to increasing interest rate environments from that demographic coming into home buying years, the credit expansion from that demographic is going to put pressure on commodities. And if commodities are short, we are going to see a very inflationary environment. That is the driver of it. I don't think when looking at this chart that this is going to be completely perfect. It might turn out to be perfect, but I'll just say this. The pressures moved up and down during that bull market, the pressure of the demographic, the rate of growth of that population. Now, this growth is persistent because we've got a steady increase in that population growth. There was no pullback in the demographic. Now, it may still come in waves because interest rates could impact the housing market. We could see a pullback in housing starts, and inventories could go up, and pulling the housing starts back, leading to credit expansion slowing down. So that is a possibility. But the one thing I want to say is we have a new shift to increasing interest rate environment. We've broken the downtrend on that 40-year downtrend plus. And it's more like the 40s, 50s, 60s, and 70s than it is like the 2000s. Because the 2000s is this guy here, and interest rates did not break that downtrend. The demographic was not large enough to break it. Or the supply of commodities were still too great. There's also other information that I'd like to share based off of where we're at in this cycle. We've got the inflation rate. So this is the United States inflation rate year over year. And you can see that we hit our head on this resistance line. This could be the first wave, and then we pull back, and then we get another big wave of inflation. If we break this trend line here, that means that we were breaking a 100-year, over 100-year downtrend line of the inflation rate. And I know that they're changing how they calculate inflation, but that is also something to note. We haven't broken out of it yet, but we could, signaling that inflation could get out of control for whatever reasons. We also can see that the producer price index versus the consumer price index is also throwing some very weird signals that we haven't really seen before. And what this is potentially suggesting is that the bull market, if we were to really get moving and start to move higher here over time, that the producer price index could outpace the consumer price index. And this here is a double bottom in this ratio. This was the 1970s and 80s. And this was the 2000s here that move higher. And what generally happens is you get these waves that come. So you get kind of like a wave, a third leg, and then a fifth leg, and then you get a double top. That's what that looks like. And that's your Batman pattern that we always see, which is a topping pattern. Now, when we look at this, this is a gigantic double bottom. It means the entire market that we are painting here is putting in a double bottom. This here was a small piece of it. This here is also a small piece of it. Now, if we go and we do some like ridiculous move here, and I don't know if this is coming, this is me speculating, but what if we come up and we break up and we do that? This here, no one knows what that looks like. No one's felt that. No one knows what the world looks like. And what this could be suggesting is that we go into potentially a hyperinflation or a commodity shortage that we won't maybe never come out of. I don't know. But it would also mean that this commodity bull market would be bigger than the 2000s, and it would be far bigger than the 1970s if it plays out that way. But it's more data, and it is showing us that we are giving a double bottom. That's the double booty bottom. We've got here, this is our active listing count. That's where our real-time housing starts are. And when we were looking at this, it's about 300 something thousand for a month of inventory. So if it was 300 something thousand, the peaks of those markets that we were looking at were located up here. That's how much inventory we need to go up to for a housing market crash. And as you can see, we're at 625,000. That is maybe a little over 2 months of inventory of active listings. We need to get to 10 months. So that's 3-point-something million to get us back up there. So we're not even close to anywhere near a housing market bubble that some people may suggest, at least given off of the active listing count, which is inventory. We can also look at some other information like the gold price in relationship to the M2 money supply. During the 1970s, gold accounted for the money supply, and we went to a very high level. And what we've got now is we've got a double bottom basically coming out. We've got the circles there that match. And this double bottom means that we've got an inflationary kind of bottoming pattern that's coming out, where gold has not accounted for the M2 money supply in the system. And when that does the accounting, we could see a vast repricing of gold. Now, gold is also a measuring stick of inflation in the system, and gold is tied with all other commodities. That's why we do gold to oil ratio, gold to copper ratio, and platinum to gold ratio, and it tells us things. This here is telling us that gold has a long upside to go, and that the bull market hasn't really even started. And if you look at a lot of ETFs, what they are suggesting is we've got double bottoms, we've broken out, and we haven't made the big run to the upside yet. We've just broken out of this double bottom pattern. And you can go along a variety of ETFs. There's your double bottom. They are all putting in these double bottom patterns, which means that commodities, if they're all putting in bottoming patterns, means that we are bottoming. That by definition. And actually, this is right at a good buy point. But it's across everything, guys. It's not across just one asset. It's across oil. It's across copper. It's across everything. So when people try to align historical charts like they did here, this historical chart here, they try to align this up. It may work like that. It may not. What I think you want to look at is what are the drivers. And if the drivers are still intact, we're going to have eventually a bull market in commodities and precious metals. Now it's just the timing. So when things look good, I remain long. And these are my thoughts in it. This is how I invest. Playing the short term, I think, is just not worth anyone's time because short-term price movements can move off of anything. What we're looking at from the big long-term, big picture view is the fundamentals of the market and how people are actually voting with their dollars. And we can see that in all the charts that they're creating because that's herd mentality. The thing that gets a little scary here is these are really big charts and everything aligns for a massive move in commodities and energy and precious metals. What is driving that? And again, if we go back and look, the demographic, which is credit expansion in relationship to the housing market, and the supply side of commodities. And guess what? Massive deficits in commodities going forward, big population growth coming into home buying years. The market conditions are set and they're there. So now we're going to have to find out how this plays out and what kind of pattern this does scribe out. But, you know, all the commodities are putting in bottoms. It means that we are at the beginning of a commodity bull market, not towards the end if we're just breaking out of bottoming patterns. Inverted head and shoulders. We've got wedge formations in lots of companies. We've got double bottoms. It's all over the place. And we're right at the ideal buy point because we've broken to the upside of those bottoming patterns, which means what's coming ahead of us is going to be an uptrend in a lot of different commodity companies and stocks and the commodities themselves. Hopefully this gives you a bunch of information, guys. I went over a lot there. Hopefully that makes sense. If you guys have any questions, go ahead and ask them below. If you guys want to join the finding-value.com to see how I'm playing this bull market, I've got some pretty good ideas. You know, I look at, you know, if energy is going to be a choke point, which I think it is, because if you look at all the chart patterns that energy companies are putting in, they look ridiculously good. I find the ones with the largest fractals and the best opportunity for the upside. So that's kind of how I evaluate it. But that's what I've got for today. Give me a thumb up for the content. Subscribe to the channel if you haven't. And we'll catch you next time. This is Finding Value.